As I told you in my previous video, ratios can be classified into 4 groups. Ratios based on their liquidity, ratios based on their activity measure, ratios based on their solvency, and ratios based on its leverage. So in this video, let's go through classification of ratios based on their liquidity. As I told you earlier, there are around 5 metrics under this ratio: current ratio, quick ratio, cash ratio, cash flow ratio, and net working capital ratio. Let's assume you would like to sell lemonades. In order to sell lemonades, you need your inventory, that is, lemons, sugar, etc., and cash to buy your lemon and sugar. So you approach a supplier. You ask him to lend or supply lemons on a weekly basis and agree with the supplier to pay dues within 3 months or a month, 6-month period, etc. Do you think he's gonna lend you or supply lemons without knowing your financial position or your liquidity position? No. What if you're gonna close your business? Or what if you're not able to settle his obligation on time? I would like to check how soon you will be able to settle his obligations if you had to sell all your liabilities at once. Assume I'm a supplier. As a supplier, I would like to know you are going to pay me after a month or 3-month or 6-month period. So what is the assurance that I may get by supplying you lemon and sugar? I would like to check your balance sheet. I go to your balance sheet. Straight away, I would like to look at your current assets and your current liabilities. Obviously, I would like to take a look at your short-term assets and short-term liabilities. I don't want to look at your long-term items and think you may sell off your building to pay my dues. That will be my extreme measure. Now, I take a look at your current assets and current liability by taking the difference between them to look if you have enough current assets to run your day-to-day operations. In other words, I would like to get an insight into your operational efficiency. In this case, you can see your current assets are 44,988 and your current liabilities are 27,970. So you have enough current assets with you as of now. So I will also check if it is proportional to the operating cycle as well. In order to check that, I see the ratio if it is balancing between current assets and current liabilities. I would also like to know how quickly you can convert your non-cash assets such as your inventories into cash, your receivables into cash, your prepaids into cash, etc. I'm a supplier. I'm going to scrutinize your liquidity position in each and every metric from now on. What is liquidity? It is a financial metric of a firm's ability to pay its short-term obligation as they come due, and thus remain in the business in the short run. And it is also an efficiency of a firm to convert its assets into cash with ease. Liquidity ratio basically measures a firm's ability by relating a firm's liquid assets to its current liabilities. And also, it represents a firm's capability to sell assets quickly to raise cash. If we take that lemonade example, if you look at the elements to calculate liquidity ratio, you require current assets. Current assets are those assets which can be converted to cash, sold or consumed within 1 year or the operating cycle, whichever is longer. Examples are cash and equivalents, receivables, prepaid items, and your marketable securities. And if you look at current liabilities are those which are to be settled the soonest, say 1 year or the operating cycle, whichever is longer. Examples are trade payables, notes payables, current maturities of long-term debts, and taxes payable, etc. And finally, to calculate net working capital basically reports a firm's ability to measure the short-term liquidity of a business and its efficiency to continue operating in the short run if it had to liquidate all its current liabilities at once. It can be calculated by taking the difference between current assets and its current liabilities. What is current ratio? Let us go back to our example. Now, as a lemon and sugar supplier, I would like to assess your ratio if your current assets are proportional to your current liabilities. I am going to divide all your current assets by its current liabilities. My intention is to check if you are in a position to meet your current liability as they come due. If the ratio is between 1.2 to 2, which means current assets are 2 times more than current liabilities to cover its debt. Now, let's try to calculate current ratio. Remember, if anything below 1.2, I'm not going to supply lemons to your store. Current assets 44,988 divided by 27,970. It's above 1.6 and I can see the ratio is higher than 1.2. I may think to supply lemons to your store. So to summarize, a current ratio is the most common measure of liquidity. It measures whether the firm has enough resources to meet its short-term obligation as they come due. So the general principle is that the current ratio should be proportional to its operating cycle. Thus, a shorter cycle may justify a lower ratio. If you take an example of a grocery store which has a short operating cycle and can survive with a lower current ratio than could a gold mining company do, which has a much longer operating cycle. Basically, a low ratio indicates a solvency problem. An overly high ratio indicates that the firm may not be investing its idle assets productively. Thus, the current ratio should be proportional to the operating cycle. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. It can be basically calculated as current assets divided by its current liability. There is a sample balance sheet too of XYZ Corporation. So you can calculate current ratio for the year 2017 and 2018 and compare its results. Pause the video for a moment and you can calculate the ratio. The current ratio for 2017 would be $325,000 divided by $82,000, 3.96 for 2017, and $290,000 divided by $76,000 for 2018, which would be 3.85. In this case, you can say the ratio has decreased slightly when compared to last year, but the ratio is more than 3, which may indicate the firm may not be investing its idle assets productively. But when compared to last year, it may have invested its idle assets productively somewhere. The ideal current ratio is 2:1. A good current ratio is between 1.2 to 2, which means that the business has 2 times more current assets than its current liabilities to cover its debt. A ratio below 1 means that the company doesn't have enough liquid assets to cover its short-term liabilities. A company employing LIFO reports lower ending inventory using a lower current ratio. When prices are rising, we pay more to acquire goods and services. Hence, LIFO produces a lower asset base. In other words, lower valued inventory stays and higher valued inventory which was purchased last moves out. And we also pay more cash to acquire inventory, thereby lowering the current assets. Now, let us go back to our example. As you are a lemonade vendor, you may have high sales during summer and less sales during winter. Or you may have to sell on a discounted amount at that time, which may be not moving out at the stated value. And sometimes you may not be able to convert your prepaids as quickly as you think. To check your liquidity even more conservatively than a basic current ratio, now I, the supplier, will exclude your inventory and prepaid items from the numerator. Remember, if the ratio is anything less than 1, I won't supply lemon to your store. Now let us check the quick ratio. Now let us calculate quick ratio. So what you have to do in order to calculate quick ratio, you have to exclude all the prepaid items and the inventory from current assets, and you have to divide it with your current liabilities. Now let's check. What is your current assets? it's 44,988. Minus prepaids, if any. In this example, I don't see any prepaids. And there is inventory. So inventory worth of 776 divided by your current liabilities 27,970. The ratio is above 1.5. Don't you worry, I will supply lemons to your store. To summarize, the quick ratio measures the firm's ability to easily pay its short-term debt and eliminate the problem of inventory valuation. This ratio is the ability of a firm to use its near cash or quick assets to retire its current liability as quickly as possible. It is also known as asset test ratio. This is the most conservative measure than a basic current ratio. The quick ratio excludes inventory and prepaid items from its numerator because it is difficult to liquidate at their stated value. So it can be calculated by its current assets excluding its prepaid items and its inventory divided by its current liabilities. Please pause the video and try to calculate the quick ratio by excluding prepaid items and inventory, if any, from the numerator. Let us check the balance sheet. So for 2017, you see $325,000 of current assets and we only see inventories, no prepaid. You exclude $85,000 from current assets and divide it by $82,000. You arrive at 2.76. And for 2018, you take current assets worth of $290,000 and exclude $80,000 worth of inventory and divide it by $76,000. And you arrive at 2.92. An ideal quick ratio is 1:1 and is considered to be appropriate. A high asset test ratio indicates the firm has relatively better financial position and its ability to meet its current obligation as they come due and quickly get rid of current obligation. Result of less than 1 indicates its inability to meet its current obligation as they come due. Even though the ratio slightly came down than the prior year, the company still has the better coverage. Higher the ratio, the better a company's liquidity and financial health. However, the company has to pay attention as to why the quick ratio reduced. As a lemon supplier, if I have to check your liquidity even more conservative way than a current or quick ratio, I check your cash ratio. Now, it's a pandemic time. As a lemonade vendor, if you want me to supply lemons on a credit, I straight away check your cash or near cash items in your balance sheet, such as marketable securities. Now, I don't want to check your inventories or prepaids or your accounts receivables because it takes time to convert these non-cash assets into cash. Remember, any ratio above 1 is considered to be a good liquidity measure. Let's calculate cash ratio. So in this example, we see only cash and cash equivalents. So you have $9,815 worth of cash and cash equivalents and short-term marketable securities worth of $16,137 divided by its current liabilities of $27,970. So you get 0.927. So it's approximately close to 1, which is again not a bad ratio. Basically, in a cash ratio, you do not have any ideal ratio, but any ratio between 0.7 to 1 is an ideal ratio, and anything above 1 is a very good ratio. I still don't mind to supply lemons to the lemon vendor. To summarize, the cash ratio considers only cash and its equivalents and marketable security to its current liabilities. This metric calculates a firm's ability to repay its short-term obligations with cash or near cash resources like marketable securities. It excludes inventory, prepaids, account receivable, etc. as it takes time to convert into cash. It can be calculated by its cash and marketable securities in the numerator divided by its current liabilities. Pause for a moment and try to calculate the cash ratio. So the cash ratio for 2017 would be $45,000 plus $65,000 divided by its current liability $82,000, 1.34 for 2017, $40,000 plus $60,000 divided by $76,000 for 2018, which would be 1.32. In this working capital measure, the firm's position declined, but the coverage is still positive, that is, the ratio is greater than 1. Basically, high cash ratios may indicate that a company is inefficient in the utilization of cash. Any ratio which is above 1 is considered to be a good liquidity measure. As a supplier, I would also check how well you are selling lemonades every day and how much cash you are generating from selling lemonades every day. Or are you just a bad lemonade maker and you have not seen customers in ages, or your sales are very rare? In order to check that, I go to your cash flow statements and check how much money you are generating from making lemonades. To calculate cash flows from operation, you add back any amount set aside for depreciation or amortization and any gains or losses from extinguishment of debt related to financing, investing, and all the accruals or deferrals. Any ratio less than 1 indicates cash problems. Now let us try to calculate the cash flow from operations. They have eliminated depreciation expense by adding it back, and gain on sale of equipment from investing activity has been reduced. There has been adjustments to revenue and expenses from accrual accounting to cash. The rule is, if you have increase in current assets and decrease in current liabilities, you deduct it. If you have decrease in current assets and increase in current liability, you are going to add it back. So the cash flow generated by operating activities are $133,000 and divided by the current liabilities. The current liabilities are 27,970. 27,970, which is 4.7 times. So they have a good cash flow ratio, and I can think to supply lemon to your store. Operating cash flow ratio is a measure as to how a firm can pay off its current liabilities from the cash flow generated from its operations. So the cash flow ratios can be calculated by cash flow from operation in the numerator divided by its current liabilities. The cash flow from operation, as I told you earlier, can be calculated by reconciling the net income. Let's pause the video for a moment and try to calculate the cash flow from operations. Assume that you have cash flow from operation for 2018 and 2017 to be $75,000 and $82,000 respectively. And as you know from the balance sheet, your 2017 and 2018 current liabilities are $82,000 and $76,000 respectively. Cash flow for 2018 and 2017 are $75,000 and $82,000 respectively. And the current liabilities are $76,000 and $82,000 respectively. So when you calculate $75,000 divided by $76,000, you arrive at 0.99, and $82,000 by $82,000, you arrive at. As you can see, unlike current year, the cash flow from operation generated by the firm in the most recent year is not sufficient to cover the current liabilities. A higher ratio greater than 1 is generally preferred by investors, analysts, and creditors, as it means an ability of a firm to cover its short-term liabilities as they come due. A ratio less than 1 indicates cash flow problems. Now, finally, as a lemon supplier, I would like to calculate net working capital ratio. I will look into all the elements to summarize your total investment, your total inventory such as your lemon, sugar, etc., your cash items and near cash items, prepaids, accounts receivables after covering all the liabilities, and thus provide a firm with its liquidity to invest. Test your ability to stay in operation in the short run. If the ratio is less than 1, as a supplier, I may think you are finding it harder to pay your bills. So let us calculate the net working capital ratio. Basically, it can be calculated by your current assets minus your current liabilities divided by your total assets. Let's try to calculate the net working capital ratio. So your current assets are 44,988 and your current liabilities 27,970. So your total assets are 116,317. So the ratio is 0.14. So as you can see, the current liabilities are taking a bigger bite out of working capital ratio. Now let us summarize. Net working capital represents that the net amounts of all the elements of working capital. So net working capital ratio is the most conservative of the working capital ratio, and it is intended to check whether a firm has enough net funds and its ability to survive in the short term to stay in operation. So as I told you earlier, it can be calculated by current assets minus current liabilities divided by its total assets. Now let's pause the video and try to solve net working capital ratio for XYZ Corporation. For the year 2018, the net working capital ratio for 2018 would be $290,000 minus $76,000 divided by its total assets, that is $609,800. That would be 0.3509. And for the year 2017, it would be $325,000 minus $82,000 divided by its total assets of $685,500. That would be 0.3545. As you can see, the current liabilities are taking a bigger bite out of working capital than in the prior year. The ideal ratio depends on your industry and particular circumstances. If it is less than 1:1, this usually means you are finding it harder to pay your bills. Finally, let us summarize. The liquidity of current liabilities, the ease with which a firm can raise funds in the financial markets, depending on the size, reputation, and creditworthiness of the firm. Firm may raise new capital such as structured funds like convertible, puttable, or callable by assessing its assets and liability liquidity during an adverse situation. Liquidity ratios can be divided into 5 groups: current ratio, quick ratio, cash flow ratio, and net working capital ratio. And you have also seen how to calculate its respective metric. Let's learn about classification of ratios based on activity measures in our next video.